Hello there and welcome to my October Perth Property Market update. I am really, truly excited to be bringing this to you because for the first time in 6 or 7 years, our market is officially around into recovery, and there's lots of positive signs in every area from the sale market to the rental market that the recovery is here to stay. And we're pushing ahead, leaving the rest of the country behind. So I'm going to take you through all the ins and outs of what I'm seeing on the ground, what I'm seeing in our rental portfolio, and why I'm so optimistic about the future and what it holds after being in slumps in the gutter for the last 5 or 6 years. It's been a real rough trot for all of us property owners in Perth. But there's definitely light at the end of the tunnel, and we're entering a whole new phase ahead. So bear with me and I'm going to jump into it. So finally here, finally around into recovery. On the Perth sale market side, what I'm seeing is the number of the sale has been heading down and tightening up since March last year. As you can see, we hit our peak at 16,600 properties. So looking back in retrospect, we actually were starting to recover from that point onwards. We had a big spatter known as COVID thrown in the works in February, March. But as you can see, from an overall number for sale perspective, it's continued to trend downwards, relatively unchanged with that COVID in the middle. COVID, if you will, has actually helped probably a bit in tightening up the market and only bringing the sellers to market that have to sell. And unlike the GFC period, we've had a lot of support mechanisms from the banks to not force anyone to sell. So there's been deferrals of loans that have kept those desperate sellers out of the market, and only those that have wanted to sell have come to sell. And that is down to unprecedented levels. We're now in line with where we were in 2014. And 2013, 2014 is the last time that I can remember that we have had an upswing in our prices and a strong sale market and rental market. So you can see we're in line with the conditions that produce those increases in prices, and we're certainly seeing price increases in many suburbs already. So I'll go a bit further into that. We're 14% down on our number for sale compared to 6 months ago, and 25% down on a year ago. And when we look at the number sold and the trend in that, you can see this. We were starting to trend up again from March slightly, working our way back up after a very long downward trend in the number of properties being sold week on week. And then we had our massive drop for COVID. Everyone stopped buying across, not everyone, but a lot, the market really fell out in April. And then you can see this massive spike coinciding with when we had the building grants. And a lot of land came on market that wasn't actually on. So that's why we didn't see the sale change too much, because a lot of land was sitting off market and or not officially listed, but developers have gone and brought their stages on. I've had my database get in touch. Jarrad, have been sitting on this land for a while, can you sell it? And that's where all these massive number of sales has come in June, July, and as quickly as they came in that month, the sales have very much dried up in the months since, especially over the last month. We've found that there's very few buyers for land and off the plan out in the market still. So hopefully if you needed to sell some land or off the plan, or a house and land package, you got them away. I certainly got lots of them away for our clients. And I'm going to go a little bit more into the building grants and what's left for the year ahead, but majority of buyers have certainly taken them up if they're going to. And what you can see now is we've returned to in line with the highest levels that we've had in this 2013-14 period, about 900 to 1,000 sales a week. And that is in line with where we might have been had things continued to more gradually and slowly come back. So we've had that massive dip down, the massive dip up, and now we're kind of in line with where we would have expected to have been if COVID hadn't happened. That's still a massive increase on 6 months ago and a massive increase on a year ago. So onward and upward, we're expecting this to continue. Now, when it comes to the house sales and median house price, we're at 475, and we've been at that for the last 2 quarters, and I would expect that to slowly start coming back up again now. I would expect it to at least be stabilized. And why is this not coming up faster, even though some suburbs are still increasing? But the outer suburbs have been very affected by the building grants. The outer suburbs, anywhere that there is land, has been distorted by the building grants. So imagine if there was a buyer that would have otherwise looked at established property, established house in an area. They've all been across the building grants, and so that has left demand weak for the established houses. And in order for them to sell, they've had to find where the market is. So that's kept prices subdued, if not still slightly decreasing in these outer areas and anywhere that there's land around those established houses. Whereas in the premium suburbs, we're seeing strong price increases, very little on the market, and anything that's well located, family friendly, premium locations and quality areas are all strongly increasing in price with multiple offers at first week. I should know, because Karina and I are still looking to buy in those areas at the moment, and we're competing against many others. When the ideal property does come up, people are prepared to pay for it now. So it's really going to be a case of a 2-speed market over the next 6 or 12 months. And when we look at the units, I expect that there'll probably be some slight falls still in the unit side. You'll see that the unit market's still trailing and in a declining stage. So this is slightly being propped up by the stamp duty threshold, stamp duty savings on new off-the-plan properties. So if you can imagine, the average new unit is going to have a higher median price, and so it's distorting the overall numbers by dragging that up or holding it up higher because more buyers are buying off the plan because of these concessions available. But what I will say is, when you look through to what makes a unit worth holding and what units have held up in price, it's those in small complex, in prime areas that have not excessive strata fees there, and preferably a villa over in a large complex. Those are doing very well and holding up very well still. Whereas the big complexes where there isn't any uniqueness, where they've lost their new shine, and places like Rivervale are in struggle town. So my heart goes out to quite a few of our clients that have apartments in there. It's going to be a long road back. So on the land, I did mention 3 months ago, I expected this to pop up, and I thought it would be interesting to see where we landed, because there was a lot of first home buyers mainly driving the building grant activity, and you can see that that has made a steady recovery since March last year as well, but more noticeably in the last 2 quarters it's shot up. I expect it's probably going to hang tight around there, and until we get second and third home buyers back buying land and changing where that median price sits. So that was just worth keeping an eye on, seeing how the land sales were going for price and where the majority were headed. mean, if you imagine 250K odd, 252 or 1,000 odd median house price, someone spends 250 on a house, they're at 500K for their total house value, and that's, you know, that's very much in line with where the median price is heading back for the houses. Now, this is probably one of the most telling and exciting slides to show that the market is holding up extremely well. 30 days on market is the average selling time. So if that's the average, there's many areas like the premium and well-located family suburbs that are, you know, selling in 1 to 2 weeks. And then the outer areas are selling in, you know, 40 to 50 days, 30 days in the middle, very tight market. So the construction grants, as I previously mentioned in my last update 3 months ago, we had the state grant of 20 grand, the federal grant of 25. Investors could get the state grant at 20, and there wasn't a lot of criteria attached to the state grant. It wasn't means tested or anything. One major condition was to enter into a building contract by the 31st of December. And even though we're in October, builders will struggle, if not be completely impossible to get a building contract together now. If you're wanting to sign up for a builder now, they'll probably turn you away. I've heard on the grapevine that over 300 building contracts have been ripped up by various builders, not able to commit to delivering, which is pretty sad. Overnight, they went from having skeleton crews to all of a sudden needing to deliver on thousands upon thousands of builds. And there's going to be a lot of pain ahead. I've sold over a dozen blocks, and I've had delays on finance directly caused by the builders on a lot of them. One builder in particular, you know, it's almost criminal what they've done, knowingly accepting more building contracts, knowing that they had no hope in hell of delivering on the time periods, waiting until the finance periods pretty much up and all the way pretending that they were putting things together. I need to come back and ask for a further 90 days to get it together. So really put a lot of sellers in the corner because we can't go back to the market and find another buyer now, and all buyers are waiting for their building contract to be delivered, and if they can't even get the contract together, how do you think they're going to go when they get to site? But it'll all come together eventually. I guess in the grand scheme of things, when a buyer is getting $45,000 plus a $10,000 grant, you know they are going to be better off overall, and interest rates are incredibly low, so at least they're not going to be paying out too much along the way when they do settle. Not only are the builders slow, and it's not entirely obvious, it's not even their fault. Their surveyors are slow, their trades are slow, all their contractors are slow, their design teams are banked up. So there's Landgate's slow in issuing titles. It's slow across the board. Banks are slow, settlement agents are doing their best to keep up. And I guess my saying at the moment, as I keep saying to people all month, is make hay while the sun shines, because, you know, we're so blessed with what we have here in Perth, and we're in a bubble compared to the rest of the world. So we've really just got to not take it for granted and do all we can while we can. So, rental market, boy oh boy. I never wanted the rental market to turn around and be so crazy tight. I mean, we all wanted it to recover. We wanted to see some rental prices come back for all of our 700 clients across the whole of Perth. But I never wanted, it to be so difficult for renters to find a place, and we certainly didn't want prices to come back so rapidly. And I guess what's making things worse is the moratorium has been extended, which I'll go into more in a second. So you can see the number for rent is at an all-time low of what I've ever been recording. well below 2013. The low point was 3,800. We're at 2,900 roughly. So massive decreases on 6 and 12 months ago. And to be honest, I think it's going to keep getting worse before it gets better. So the only thing that's going to add more properties for rent while we're continuing to have people return to the state for work, and there's many returning travellers that will rent for a while. I know once the borders open up, we're going to have many people flocking to our relative safety that will rent before they buy as well. So the only thing that's going to alleviate the rental market is more investors coming in, which they're starting to, thank heavens. So they'll be buying rental properties to put on the market and add to that supply. And as tenants become fed up with the increasing rental prices over the coming 6 months, I think they're going to be increasing by as much as 20 to 30%. That'll be prompting as many of them that can to get out and buy their homes. And with interest rates as low as they are, people are going to very quickly realise that home ownership is very attractive. And that combination of investors purchasing in our market and tenants getting into the home ownership side is going to see our second wave of activity, if you will, coming over the next 6 to 12 months. So the first wave of activity is very much been towards the land and building grants, as well as the premium areas. The second wave is going to be driven by the tenants and the investors. So enough talk, let's get into some more stats. You can see that we've only got 16 properties for rent. At the moment, we usually have 30 to 40, so very tight on our side. We've only got a few more available because we've got quite a lot of new clients joining us, and there are many people frustrated with their property manager out there that are continuing to seek us out for the peace of mind that we can give. Little side note, we are guaranteeing new clients that are coming to us. At the moment, we guarantee their rental payments, so we're doing that until the end of March. And that's because the majority of landlord insurers are still not offering landlord and insurance that covers loss of rent. So we're providing that loss of rent coverage, if you will, for our new clients that join us at the moment. So pretty crazy offer that I've come up with, but it's only because we're managing things so tightly, and it certainly won't excuse your tenant from paying rent. We'll do everything possible to follow up with them, but I'll cover it in the meantime if they happen to fall behind. So rental vacancy rate. Now this is the most telling sign. We were dropping from our massive 7.6% back in October 2017. We are now at 1%. So anything under 3% puts pressure on prices. At 1%, they're going up and they're going through the roof. So hang on. On the average rent side, we've already seen an increase of 8% show up on 12 months ago. So we're now at $390 per week when we were at $350. And we've got a lot more to go. So we were up as high as $480. I think we're going to regain this over the next 12 months, and if not, push ahead above that and before coming and correcting as more tenants do start to get out, more investors do start to buy. So that's what I think's ahead. Now, property clock timing. So this became official a month or two ago. I nearly was going to release a market update just to tell everyone about it. It was so significant that Perth had been labelled as starting a recovery. I expected it to have happened, and it did. And you can see that Sydney and Melbourne are around in a declining market, most notably, and Darwin, who is usually in sync with us, is around in the start of recovery, and Brisbane has, I think it was previously around in a rising market, has dropped back a bit. On the unit side, Perth is still sitting in a declining market for units, and I'd agree with that, along with Sydney and Melbourne's unit markets over there in a declining market. So, factors affecting our market and what has changed since 3 months ago, worth mentioning. Availability of finance, rates are unchanged since then, but we're expecting a further drop in November, or at least before the end of the year. How much further is there to drop? Well, we're at 0.25 cash rate now. They might, I think we're expecting a 0.2 drop. The banks may not pass any of it on. They might pass a little bit of it on. The main reason that the RBA is dropping that is to affect bond yields, from what I can understand, and make it cheaper for the government to finance all of the stimulus that it's borrowing for. So it's more about the government's financing than it is about stimulating, borrowing, or the commercial, the general loans, more for the bank finance. And the banks are still fighting hard to keep customers. Just scope, you should be under 3% in your loan interest, and you can fix now in many cases for low 2%. Again, whether you should or shouldn't needs to be strongly considered. I can't advise in that area, but speak to your finance broker or financial planner about that. Obviously depends on, whether you're planning to stay put and you can't park money in your offset account and save interest if you do move across to fixed. So there's a couple of variables in that to consider. Loan assessment criteria, most notably, is changing to make borrowing more easier again. So this is very significant for investors and homeowners, and borrowing is going to become a lot easier. I'm not sure exactly what date the changes apply, but it's going to be affecting borrowers. And I attended a Macquarie briefing for private wealth clients during the week, which was fascinating, and I made lots of notes, but the summary of where they saw things headed with finance was 5 years of low interest rates. So the RBA has also come out and said that for the foreseeable future there will be low interest rates. That should give both homeowners and investors confidence in borrowing, and also give you a bit of time for any property purchase, for instance, to work its way up in rental return and give you some breathing room. At the moment, where a property would otherwise be negatively geared, it's likely to be, neutral to positive for the next while. So, building approvals to June. Now, all the grant approvals haven't shown up for us yet, so I'm not going to go too much into this. They'll start showing up in the coming months. Employment, this is worth keeping a track on, because you see a lot of positive things coming out for WA, but really, when we look at how we measure up compared to the rest of the states down the bottom here, we're at 8.3%, which is one of the worst unemployment rates, and that's to July. So obviously it's tracking behind where the actual market is. But you can see that, places like Tasmania, places like Victoria are actually doing better than us for unemployment levels. New South Wales is also. So we're one of the worst and hardest hit. And it's very much a case of, outer areas and certain sectors of the economy being hit harder than others. So there's a lot of people that I speak to that are having their absolute best years in business and doing exceptionally well in their jobs. And so they're the people that are driving our market at the moment. And my heart goes out to anyone that is still affected, because when you see these stats and these numbers, it really does remind you that there's a lot of people that are still got pretty uncertain about their worlds and still not, without employment. So Macquarie said it's likely to take a few years to get back to the levels that we were. And they also commented that they only saw growth ahead for the next 12 to 18 months, and they were expecting 8 to 10% capital growth. And this is just me quoting some of the things that I remember. So, be careful with my second hand. But what I took from it mostly was that they were very optimistic of the road ahead, regardless of what might happen with the second wave or outcomes in the US or in China. So they thought we were going to be very resilient with the amount of stimulus that has been pumped in and is continuing to be thrown at this. So policy changes, and I started to touch on a few of those. The budget was released over the last month and saw the tax cuts for individuals passed on, which will likely boost spending back into the economy soon. So that will help the turnover and get that spending going. Majority of the focus for the budget was on stimulating business, so stimulating the asset purchases with instant asset write-offs, and stimulating job hires, which certainly helps to give employers confidence in this time to go ahead with those hires that might have otherwise been more difficult to make. So that's the main things that I took from it, and we might not be seeing too much individually, but it's great that they're putting the focus and attention on businesses getting back on track, because it's going to certainly help our property and share markets, as well as anyone without a job. So far the stimulus is reported to be around 3 times what was spent across the whole of the GFC, which is absolutely phenomenal considering we're not yet through this COVID period. And it was notable from Macquarie that China's recovery, because they went into being affected by the virus first, their recovery is happening first, and they're pulling the rest of the world up with demand for resources coming back on. We're going to benefit most directly from China's recovery, helping us come out of our slump. So it was also noted that the outcome in the US elections not seen to be of any great consequence with regard to the economic outlook, and under either president, there's going to be lots of stimulus continuing regardless. So now, a bit of a contentious one. The impact of the Residential Tenancy Act has been extended until the 28th of March. We were very shocked that this happened, considering only around 1% of tenants have been actually affected by COVID and experiencing hardship. So the government, it's very disappointing to me and many of our clients that they've extended this blanketly. What they should have done is focused the help and support on those that are affected by hardship, because by effectively, locking the market down, it's not helping turnover of properties. And I can understand their reasons. They're trying to keep stability for longer. But every time you artificially, put controls on a market, it doesn't allow it to correct. And then you can actually have adverse effects with even greater rent increases coming by not allowing them to happen sooner than. And so the rent increases has been the major one. We had over 200 rent increases issued to occur on the 1st of October, which all had to be retracted. And now we're revisiting them to, begin on the 29th of March, typically seeing 10 to 15% increases so far. By the time we roll around then and place any new tenants by then, I expect 20 to 25% increases. And so it's also been very, very difficult on landlords that have not been able to move back into their rental properties. So they can go and claim hardship from a court and try to get access that way, but very difficult process. And it's also been incredibly difficult on tenants trying to find a property to move to and move out, and very difficult on tenants that are new to the state. So that's not all because of the extension of the COVID-19 Act, but the rental market is very, very difficult for everyone at the moment. And we're just trying to go about having some understanding and helping where we can, both sides, tenants and owners, get through when they have been affected, and explaining what we can and can't do for the road ahead. So very appreciative that not more of our tenants were affected, and very grateful that they're doing so well. Now, the rent relief grant has been extended and is still available if you experience a complete job loss. Check into that. So, some tips to thrive and survive. This is more for those that have managed to put some savings together, have managed to be in a position with security around their jobs. It's a great time to look at upgrading or buying an investment property in the well-located areas. Now, these are likely to be unaffected and will continue to increase in price. So I can't see any downside in buying in these well-located and quality areas. Great time to do it. Outer areas are starting to see some increased buyer activity. So if you've got a property there you've been wanting to sell, consider doing so now. And it all depends what you're planning to do with the money and your reasons for selling. So your property shouldn't be costing you money with interest rates as they are. Make sure that you've got the best rate possible. If you are looking to reinvest some equity that you've got into a better located area, that can be a very good reason to do so now. If you're looking to recoup some borrowing capacity or equity that you've got in a property for use in upgrading your house, that's a great reason to do it now. But if you're looking to sell just because you're at your lowest point of emotions, what you need to understand is when the market's at its bottom, that's when our emotions are also at their bottom. And I spend a lot of time each month just talking people out of selling if they don't have a strong reason to sell. They've held on this long. You might feel very different about your property in 2 to 3 years' time if it increases by 30 to 50% or more. So try to write those emotions out. Look at things logically. Does it make sense to sell? Do you need the borrowing capacity back? Do you need the equity back to do things with? And if the opportunity cost of keeping that property is greater than what else your plans are, then look at selling it and getting the best price. And I can certainly help you with sales all over Perth. It's what I specialise in. And I'm only too happy to give a free market appraisal and keep you updated so that you can choose your timing. Now, my crystal ball. Rents, I've upscaled this to a 20 to 30% increase over the next 12 months before some easing pressure when tenants move into newly built homes and want to get out of renting, and more want to get out of renting. There'll be a lull in land and new home sales from now on. The market well and truly being spent on that. And investors have started coming back to the market. We're hearing from our buyer's agent friends over east and helping many of their clients with finding tenants, which is very easy to do. Still wanting to be highly selective in finding the quality tenants and maximising the rent that we can get at that point. So what we're finding at every home open is 20 to 30 people coming to home opens minimum. We're usually getting 5 applications beforehand or more, with many tenants offering large amounts of rent in advance and over the asking price just to try to secure something. So it's a seriously competitive rental market out there. Established homes in outer areas are negatively impacted over the next 6 months, with the building grants having taken a lot of the buyers out. But they will benefit from the increased investor and home buyer demand as we move around into this next phase. So I expect we'll continue to see the price rises in the inner quality coastal and well-established areas that don't have land supply, and immigrants will start to be lining up at the border, if you will, trying to get into our relatively safe and robust economy. So many positives ahead, and it's just nice to be coming to you without so many negatives to report for once. I'm feeling a lot better about what the next 6 to 12 months holds, and I'm sure along with you, I'm going to be excited to get 2020 out of the way. Hopefully we can get back to doing some travel next year, get back to some holidays, and hopefully we can get back to some increases in sale prices for those that have held on for as long as they have. So let me know if you needed an update on selling price for your place. We can help with rental. We're specialist property managers all over Perth in 200 suburbs, and I'm only too happy to help whenever you need some property advice. Get in touch. See ya.